when it comes to investing, it must be true that even 10 years is noise, or likely to be noise. And the reason is, if it wasn't true, there'd be no risk premiums. You cannot make the argument that the value investing has become crowded. That's obviously wrong. Active management is even more of a loser game than it ever was. If you ask the average investor which industries have had over the 100 years the highest returns, they would all say either healthcare or technology. And it's the sin stocks, which are all value stocks of gambling, tobacco, alcohol.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Larry Swedroe, renowned author and respected financial and investing expert. We ask Larry some big-ticket questions that come up a lot in our discussions, including whether systematic value investing is dead, how passive investing and flows are impacting the markets, the effectiveness of fundamental-based strategies, international diversification, the impact of AI on investing, and much more. Larry provides thoughtful and insightful answers, offering investors practical advice and a deeper understanding of today's most pressing investing challenges. As always, thank you for listening. Please enjoy this discussion with Larry Swedroe. Larry, how are you? Thank you very much for joining us again on Excess Returns.
It's my pleasure to be back. Dylan Fine, I'm on the right side of the grass. It's a good day.
You spent your career educating investors on a whole host of topics: factors, evidence-based investing, long-term investing, how to be better investors, and how to think about markets. And we've talked to you about a lot of different things on the podcast over the years, but what we thought we would do today is kind of take a little bit of a different approach with you and sort of talk through some of what we believe are some of the things that are on investors' minds, some of the things that might be maybe a little controversial with different sets of investors, types of investors, and sort of just get your opinion and your thoughts and your feelings on where some of this is headed. And I think hopefully what investors can learn from this and these topics. And so there's a bunch of different issues: the effectiveness of value investing, and also factors, the rise of passive investing and the influence of markets, and then get your thoughts on market concentration. But I guess to start, let's start with value investing and this idea that that maybe systematic value investing is dead, or maybe its effectiveness won't be as much as it's been in the past due to maybe a whole host of arguments or issues that we want to work through. And there's a lot of them, so we don't want this to be like a list type format. But I guess the first one is to hear your thoughts on what influence the Fed has had on value investing with the rates and value relative to growth stocks.
To answer that one, what I do always is look to the literature. And the literature says there is no real good answer to that one, because the movement of interest rates has various effects. And rising and falling rates don't seem to have too much of a shift in the yield curve a bit seems to have a very modest impact. And the reason that there isn't a lot of relationship, or at least not strong ones, between value and interest rates is, think about it this way. Let's say you have interest rates are, just to pick a number, 5%, because we think growth will be 2% and inflation is 3%. Now, what happens if inflation drops to 2%? Well, then the interest rates have dropped from 5 to 4. But that should have no impact on corporations whatsoever, because corporate earnings are real and they move up and down with inflation. If you have 2% less inflation, corporate earnings in a real sense will be unchanged, but in a nominal sense, they'll be down, which means this whole idea of this, the Fed model and interest rates is nonsense. Think of it also this way. Let's say interest rates go up from 5 to 6 because you're going to get 3% growth and 3% inflation instead of 2% growth and 3%. Well, what is that? Why is value going to be impacted by stronger economy. Which means there's less risk in the economy. Corporate earnings will be stronger. So that should offset any change in interest rate, should have no impact. And stocks shouldn't be higher or lower valued because they shouldn't be impacted. There should be this offset here. So the evidence is very unclear. What we do know in terms of economic growth is this. Value stocks, particularly small value stocks, tend to do poorly when at the onset or people are anticipating recession. And that makes perfect sense because value companies tend to be riskier. That's why they're trading cheaper, right? They, for example, tend to have more irreversible capital. They can't cut their spending as quickly, okay? But then they tend to recover much faster because the market begins to anticipate the recovery. They know the Fed will act. They know the government will act and cut spending. Increase spending, fiscal stimulus. And that should help by making them less risky again. And their earnings tend to grow much faster coming out of recessions. So that's about all you can say. And the problem is there are no good forecasters who can predict these things well enough that you could take advantage of it. In fact, we often don't know until 9 months later when a recession actually started, right? The government, the NBER, which is the official declarer, doesn't even announce it often until 6 or 9 months later. So my view is that we don't know that what the Fed impact may have had. My only other comment would be this. My opinion, the Fed made a horrible mistake in monetary policy. I actually had a debate with Federal Reserve, head of St. Louis's Federal Reserve at a conference by keeping rates suppressed for very long. And what that meant is that interest rates were zero, meaning the price to take risks, went way down because you didn't have, the alternative of a risk-free rate. And that drove people into very risky assets. And that helped a lot of growth and lottery-like spots and those kinds of things, spurring investment in speculative assets. So that sense, yes. Now, the reverse, you would think, would eventually be true.
Do you think there's anything to be said for too many people being value investors? And I'm not talking about traditional, concentrated stock picker value investors, but in terms of these quant strategies and index-based strategies that are trying to tilt towards value, do you think just the pure amount of assets in those strategies has sort of affected or reduced the value premium over time?
It's a very logical question because we know, and it's very logical, that when academic research is published, they uncover a risk premium, right? First of all, you might ask, didn't the market know this already? Okay, well before Farmer and French and even before others in the 80s, quote, discovered this value premium, people like Benjamin Graham and Warren Buffett had been value investors for decades. So it wasn't like it was a brand new idea. But once this stuff gets published, a lot of people may say, hey, this is a good thing. I'm going to add assets. So one of two things can happen. If you're a risk-based premium, then that premium should shrink, right? Because more people are buying it, but it should never disappear, at least if markets are logical. Because if it's risk-based, there should be a premium. But premiums are time varying depending upon the economic regime, right? And if the economy is doing well, then the value stocks are less risky. If the economy is doing poorly, then they become more risky. So the premiums should jump up and down. Unfortunately, as we just said, there aren't good predictors. Now, the question is, what happens when that premium moves, right? Well, if lots of money flows in, the premium shrinks. Let's just say we're at a starting point when PEs for growth stocks are 20 and value is 12. Well, if money is flowing in and coming out of growth, the PEs relatively will be maybe 18 for growth and 14 for value. So it means the value premium has gotten smaller, but it's still there. Okay. So that's what should happen if it's risk-based. If it's behavioral-based, it should virtually disappear, but there are, we know, limits to arbitrage, like the risks of shorting. And we should talk about that because I think that's changed a lot in the last few years. Not only the risk, but the costs of shorting. Okay. So now to answer your question specifically, while it's a logical argument, if more people are investing, the premium can shrink. But the exact opposite has happened because we're in what I would call a story or narrative environment, no different than we were in the Nifty 50 area, in the era of the late 90s and the dot-com. And now we have this narrative about large growth stocks, technology, whatever, okay? And the spread has widened. So you cannot make the argument that too much money is chasing value because the spread should have come in. And Cliff Asness and the team at AQR has written a bunch about this and wrote some papers you can find on their website, on their mountain, that show that the spreads, last time I remember their last analysis on this, they had reached like the late 90s level of the 99th percentile of cheapness. And then they've come back since. Maybe they're in the high 80s or 90s still. So you cannot make the argument that the value investing has become crowded. That's obviously wrong.
You mentioned the narrative-based market, and that's something you hear a lot now, is that people care a lot more about narrative than they do about fundamentals, and that's a long-term thing now, that we expect that to persist, and that's a problem for value. What do you think about that?
I think, again, that's nonsense. The problem is this. One of my most used expressions is that when it comes to judging investment performance, whether it's a strategy or a mutual fund, whatever, the typical investor, and this includes, unfortunately, even most institutional investors, and in my experience, even many professional advisors, okay, they think 3 years is a long time, 5 years is a very long time, and 10 years virtually infinity. And we know this is true based upon the cash flows, based on Morningstar's ratings. We know it's true because even consultants who should know better, they look at 3-year periods, maybe 5, and then recommend to these endowments and state pension plans to keep shifting and strategies around and firing managers. Well, the research makes very clear that the managers that they recommend hiring go on to underperform the very managers they just fired. That tells you that this idea is bad. If you're any good financial economist would tell you, when it comes to investing, it must be true that even 10 years is noise, or likely to be noise. And the reason is, if it wasn't true, there'd be no risk premiums. Because all you have to do is wait 3, 4, 5, or 6 years, and you're going to get your return. And if that was true, then the risk premiums would shrink dramatically, and we wouldn't see the kind of volatility we see in the market. So let me give you one good example. I wrote about this 20 years ago or so. In 1999, at the end of the year, of course, this was the dot-com bubble, and growth stocks were going through the roof, and value was dead, and Warren Buffett was declared, as the expert, like an idiot. He doesn't know better. Time has passed him by. He had his worst relative performance during that period. At that point in time, when you look back 1, 3, 5, 10, or 15 years, value stocks had underperformed. There was a negative value premium. Most investors, I think we can agree, would say that's a really long time. If you wait 1 year, every one of those numbers reverses, and there's a value premium in every single period. And we know that next decade, value went on to outperform dramatically. In fact, from 2000 to 2007, it had the biggest value premium ever. And we reached those kind of spreads, not too long ago. And I think that's a good example that investors should keep in mind. We've seen the same thing before in bubbles and growth stocks in the late 20s, in the 60s, in the 90s, and it's certainly possible that we're seeing now. You have to have a very long horizon. And here's my last point on this subject, which is, I think, the most important takeaway for investors besides having a very long horizon. You should never judge a strategy by the outcome, which is what most investors do. You should judge it by the quality of the investment decision-making process. And if your process was good, which you can question, and you get a bad outcome, all that needs is the risk shoulder. And as we just discussed, 15 years is noise. And anyone who doubts that, just look at the period from 1969 through '08 and large cap and small cap growth stocks. 40 years underperformed the 20-year Treasury, which is the riskless instrument for a pension plan with nominal obligations. 40 years. Do you give up on the investing in growth stocks because of 40 years of data? I would hope not. But that's the perfect example of why you have to understand that all risk assets are going to experience long periods of underperformance. And that doesn't mean you should avoid investing in them. What it means is you should hyper-diversify so you don't get stuck only owning the thing that is done the worst, which always happens after periods of high valuations when everyone thinks there's no risk, like investing in technology, etc.
This next one comes from our interview with Aswath Damodaran, and he had made the point that, back in the 1970s, if you wanted to run a Ben Graham screen, you had to go to a physical location, you had to find a book, you had to make the calculations by hand. His point was, we should expect the strategy to be less effective now than it was back then because it's much easier to do. I mean, I can go to any website and run a Ben Graham screen in about 2 seconds now. Do you think there's anything to that?
Absolutely. We said that earlier. Once you have academic research published, you should expect the premium to shrink because more people will take advantage of it. And also, you have to be aware that premiums are time varying. And in fact, I think the risks are much greater to investors because of AI and high-speed computers. When I was going to college, my first year, which I'm really going to date myself now, when you wanted to test a hypothesis, like does price to book work, you would program it on punch cards, take it into my computer class, and hand it in. And you'd be lucky if 2 or 3 days later you got the answer. And you couldn't run multiple tests because it was very expensive to do. So the key was how to have a hypothesis before you ran the data. Today, that is no longer required because of the access to great databases and the ability of high-speed computers. Now you can run for almost no cost an infinite number of strategies, and then you get a data mining outcome because there may not be any causation. So you have to make sure, in my book on factor investing, and also pointed this out in my book, You're a Complete Guide to a Successful Secure Retirement, and my Black Swan book. Here's the key. To minimize, you can't completely eliminate the risk of data mining outcomes, but you can minimize it by requiring 6 things from an investment strategy. First, there has to be a premium for you to even think about investing. Then the premium has to be persistent across long periods of time and economic regimes. So it wasn't just a lucky outcome. That's number 1. Number 2, it should be pervasive across sectors, industries, countries, regions, even asset classes. So we know value, buying what's cheap, works across every country in the world virtually. It has worked across industries. Okay. So you get a higher premium by buying cheap technology or healthcare stocks than you buy, the higher growth stocks over the long term. So it works there. It works whether you use price to book, price to earnings, cash flow, EBITDA, enterprise value. It has to be robust to various definitions, as we just said, and it has to survive transactions costs. It doesn't matter if you get a 4% premium on microcaps and it costs you 5% to execute. And last, there better be a good risk base, my preference, because you can't totally arbitrage it away, or a behavioral explanation, which I'm willing to accept. I just wouldn't put as heavy an emphasis in my asset allocation for factors or strategies that are behavioral based, because they could, in theory, be eliminated. Now, I think human behavior and limit don't change or tend not to, and limits to arbitrage make it very difficult to go short. And the recent incidences, say, with Melvin Capital and GameStop, where these, Reddit investors ganged up legally to go and attack them, shows how expensive that can be, right? So those criteria have to be met, all of them. Otherwise, you should not invest. So I think Darren is directionally absolutely right. And that's why you can't just blindly invest. You always should consider valuation and be willing to, stick with the strategy if maybe the valuations are now showing, hey, the premium has now gotten smaller. And if you're not, then you should abandon that strategy, because you say, I'm not willing to take a risk in owning stocks if there's a negative risk premium. And I can give you a good example. In 2000, in my opinion, there was clearly a bubble. So I think Fama is wrong saying you don't know when a bubble exists. To me, a bubble is when the yield on PIPs, which is a totally risk-free investment you hold to maturity, was higher than the Cape 10 inverted. So the earnings yield was like 2% or 2.5%, and TIPS yields were well above that. That to me said there's clearly a bubble, which had to be resolved by either PEs falling or TIP yields falling. And if TIP yields fell, you'd be very happy with a big gain on some longer term TIP. So hopefully that answers your question on Darren.
It does. And I can't tell you how many times I've used that framework of your criteria in my career to explain, to look at factors and to explain factors to other people. So that's been a great service to the community. You guys put that out there.
I only asked, did you quote myself and Andy Birkin when you
We always do.
Well, that's great.
We always do.
I see it quoted all the time or reference, and I almost never see, us giving credit for it. But I do take pride in the fact I believe we were the first people to put that in writing.
Another point Demoterin made was this idea of the rise of winner-take-all businesses. So he gave the example of Airbnb with hotels. And he said, if that's becoming a winner-take-all business, and Airbnb is eventually going to dominate, and we can obviously argue that, but are the other hotels, which might be sitting in the value stock range, are those worth less than they were before? And so maybe they look cheap, but they're not actually cheap as technology takes over and we get more of these winner-take-all businesses.
That statement assumes that the market is ignorant and can't foresee it and hasn't already priced it. And is the market right or wrong? And you're betting, let's say in that case, one, that Airbnb will be the winner, and number two, that it will in fact knock out the others. Right? And the market is stupid and doesn't recognize it. And you're smarter than everyone else. If that is really true, then what we should be seeing is more evidence that active managers are outperforming. And the exact opposite, as we wrote with Andy Birkin in The Incredible Shrinking Alpha, the percentage of active managers who are outperforming has been declining rapidly. And when I wrote my first book in 1998, it came out virtually the same month as Ellis's book, Winning the Loser's Game. And when he wrote his book, about 20% of active managers were showing statistically significant alpha. Okay? By 2010, just 12 years later, Fama and French published a paper showing that number, pre-tax, of course, here, was down to about 2%. Other papers since have confirmed that. And so after taxes, since most of us tend to pay taxes, certainly higher net worth individuals have most of their money taxable account. That, with taxes being the greatest expense, you're probably at 1%. I don't know about you, Jack, but I don't like odds of 99 to 1 against me. I don't buy that argument, even if he's right in terms of that is going to happen. But I would argue that that argument has always been made, that someone's going to be a winner. And the market drives those prices to often crazy levels. And digital equipment and Data General and Polaroid and Kodak were dominant in their industries. And every one of them is gone then. They were the Airbnbs of their day, right?
Yeah, absolutely. And the next one kind of is a parallel to that, which is this idea that value is underweight technology. Because, if you run an unconstrained value strategy today and you look at the weighting of the S&P of technology in the S&P 500, you're going to be way below that. And the idea is if technology continues to be more and more and more of the market because it does so well, we're hamstringing ourselves as value investors by having this underexposure to technology. So what do you think about that?
Yeah, so I would make two arguments. First, the evidence is, I think most people would get this wrong. If you ask the average investor which industries have had over the 100 years the highest returns, they would all say either healthcare or technology. And it's the sin stocks, which are all value stocks of gambling, tobacco, alcohol. And that's true in other countries like the UK. So that's falsehood number one. But the other way to address this problem, which I think is logical, is you can address that in the way AQR does, and to say we're going to be industry neutral. So what you do is you say, technology, say, is 20% of the market cap. We're going to hold a portfolio of value stocks that's 20%, and we'll buy the cheap stocks in the value sector or, the value industry. The problem has also become another one, though, which we should mention, is 50 years ago, value companies and companies in general looked very different. They tended to be mostly physical assets. So book value was a good measure, and it was good because it was also very stable. So when you go to implement, you don't have a lot of turnover. PEs are much more volatile, and people forget, even if PE was a little better predictor of returns than price to book, it would be a lot more volatile. You have a lot more turnover, a lot more trading costs, and you may end up with lower returns, which is why Fama and French originally chose price to book. They've adjusted to include things like profitability. Others, and the evidence shows, you're much better off in almost everything using an ensemble method, using multiple metrics, because they all work. They're robust for various definitions. And in different eras, different metrics work better, so you get a diversification benefit and smooth it out. But here we're talking about, now you have intellectual capital, which is often the greatest asset of companies, and that doesn't show up because it's not accounted for. So it doesn't show up in the price to book. So what some people have done, and it's very tricky, is to put that back on the balance sheet and then depreciate it, just like you would with physical capital. And that would have helped somewhat to address the value premium. It would not have solved the problem, because most of the outperformance in growth stocks was not earnings growth being much faster. It was multiple expansion, which can't be repeated unless you think trees grow to the sky. But that is a way to try to address it. The hard part is to measure how much of that intellectual capital will be realized and how much will be wasted, on bad investments. You really don't know until often 10 years later. So it's very tricky. DFA or dimensional, for example, has decided not to do that as well. So other metrics can help address that, looking at cash flows, for example.
Just as an aside on your point about running value sector neutral, what are your thoughts on that? Like when we had Wes Bray on, his idea was if you're running it long short, you probably should run it sector neutral. If you're running it long only, you should probably run it more unconstrained. Would you agree with that?
Here's the problem, and I won't argue at all with Wes. I would hate to be on the other side of an argument with Wes or Cliff Asness. So both of them are smart people, and they disagree. Certainly, we know that over time, different industries dominate value. Some years it's oil stocks, some years it's automobile stocks. And you want to own them because they're really cheap and distressed, right? And that's how value premium has gotten so big. And it's also why the value strategy has worked, because most investors, what are you, crazy? I'm not going to own these lousy auto companies. And they can't take it. And after 3 years of bad performance, they bail out. And we know that reversion to the mean of abnormal earnings is the most powerful force in the universe. So remind me, because I want to come back to that point. This is really important for investors to hear. Okay. So human behavior is critical. In fact, if you're an investment advisor, I tell people you're not really managing money, you're managing people and their behaviors. Because most people make these mistakes, not only of recency bias, but relativity, comparing their portfolio to something else which should be irrelevant, or you would own that only, okay? So if you are sector neutral, you reduce the risk of tracking variance, which is a big behavioral problem for investors. You won't eliminate it, of course, right? But you will reduce it because you will own more of, in this case, technology. I don't think it would have prevented lots of investors from bailing, but it might have prevented some. So if you believe in human behavior being the problem, I think that's a good way to go. And I think because of changes in regulation and stuff, that would be my preference. But, I won't argue against the other strategy because there is logic to it.
I was excited to have you on because I wanted to ask you about a recent research paper that came out that we actually had the authors of the paper on, and it sort of called into question, I think, the last part of your evaluation criteria for factors, which is the intuitive part of it. And it was Andrew Chen and Alejandro Lopez Lira. And what they did is they put factors into buckets. They looked at factors with a risk-based explanation, a behavioral explanation, and then factors effectively with no explanation. And they looked at them, they tested them, and then they looked at them out of sample. And what the conclusion was, and you can probably explain the paper better than I can, but the conclusion was there really wasn't much of a difference there in terms of the risk-based factors, the behavioral-based factors, and the ones with no explanation. So it calls into question the idea of, do we need an explanation of why these factors work for them to continue to work out of sample? So I was just wondering what your thoughts are on that.
Absolutely you do, and I think they drew the wrong conclusion. I'm not arguing with the findings of the paper at all. The findings are what they are, right? And you don't throw them out if they don't happen to agree with your views. So the first thing is we know that there are limits to arbitrage and the risks of shorting and the cost. So behavioral explanations can persist. I mean, Fama, who is the father of efficient markets, he fought against momentum and including it in strategies for decades because there is clearly no good risk-based explanation. It's purely behavioral, right? And even he eventually, maybe with Ken French pushing him, DFA decided, dimensional, we're going to incorporate momentum signals, at least eliminating buying stocks that are crashing from our portfolio until the negative momentum ceases. So a growth stock that became value, they would buy it, but now they would say, no, we will not buy it, we'll delay. It'll be in our eligible list, but we won't buy it until that negative momentum stops. And stocks that are growing rapidly and they leave value, we would have sold them early. Now we may delay the trade a little bit until the positive momentum. So they prioritize things in that way. So because something's behavioral doesn't mean it can't persist. That's number one. On the value side being risk stories, okay, well, we've just discussed that when something's published, you should expect the premiums to come down because money is going to flow in, right? It doesn't mean that the premium doesn't exist. It means it's likely to have shrunk because more people are aware, more money is going to come in. If there's a risk-based premium, the logic is you cannot arbitrage it away. So the only question is it really a risk-based premium? Is there logic behind it? And you want to look for the academic papers that would support that. And with value, just to add this, there are really good papers showing a risk-based premium, and there are really good papers showing a behavioral one, which is mostly that growth stocks are persistently overvalued. And now I'll come back to the point I mentioned earlier, which is on the reversion to mean of abnormal earnings growth. The reason by far that growth stocks tend to underperform in the long term is that investors persistently, including analysts, overestimate the ability for abnormal earnings growth to persist. That's this Airbnb argument, if you will, that Damodaran is making. So let's say that typically earnings are growing at 6% a year. Okay, so 3% real, 3% inflation. And you're growing at 26%. So you're growing 20% fast. Farmer and French wrote a paper long ago, I think about 20 years ago or so, maybe even 98, so 26 years ago now, which found that abnormal earnings growth, both positive and negative, tend to revert to the mean at a rate of about 40% per annum. And that's very logical because you have the abnormal earnings growth. What does that do? It attracts competition. If you have negative abnormal earnings growth, what happens? Companies exit the industry, capacity gets shut down. And the negative side tends to revert even faster than the positive reverts down. So they look at the estimates from analysts, the IBES kind of data, and they find that the analysts persistently overestimate this growth rate. In fact, they're underestimating the reversion to the mean. And that is ultimately what causes PE ratios to come down, and that's why growth underperforms. Investors are overconfident about the ability of companies to either grow persistently or to forget that the economy, causes, contraction in industry, so supply shrinks. Just think about any mining stock. What happens if, some mineral is in short supply? Well, it takes a long time to open a mine, get regulatory approval. It may take 5 or 10 years before you get the ore out of the ground. But then all of a sudden the prices go up and up. And then all of a sudden the supply comes on board and the prices go crashing down because you got new supply. So the earnings revert to the mean. And the same thing happens when prices are too low. Capacity gets shut down. May take 5 years to restart a mine or whatever. And so you get these cycles. And so every industry has these issues. And I think this gets overlooked, and investors chase whatever is done well when.
What do you make of these factors that we can't come up with a good explanation for? Like in their testing, they held up in the data, they held up out a sample. They were doing things like dividing cost of goods sold by accounts receivable or something. They were just combining everything together. But I mean, is there an argument, especially in a world of machine learning, that we're going to see more and more of that stuff being used? Or, should that stuff be used?
No, that's the real danger of artificial intelligence. The outcomes are very likely to be data mined. You're torturing the data until it confesses, is the expression. And that's why I would be extremely careful to never invest in any strategy that doesn't meet all 6 of the criteria. Not even if it meets 3 or 4 of them. It's got to meet all 6 because that risk is there. It's very easy to create a good back test, but it's meaningless. The best example, and this is back in the 90s, I think, an economist ran the UN's database on economic statistics, and he found the best predictor of the S&P 500 was butter production in Bangladesh. Now, I think any rational person would not believe that that has any predictive value and bet money on it. But that's exactly what can happen. So you should ignore it. But it's a huge risk out there with these products because of artificial intelligence.
I just have one more topic area I wanted to cover before I hand it back to Justin. I want to ask you about the rise of passive investing. It's something we've talked about a lot on the podcast. It's something I've been thinking about a lot. And particularly the question, does this impact the market in some way? I mean, many people argue it does not. But as I think about it more, and I think about the idea that, if the liquidity of these big companies is not scaling with their size, is it possible that more and more people putting money into their 401ks is increasing the value of these bigger companies relative to the rest of the market? I mean, do you think there's anything to that?
No, I don't. But here's what I think has happened. First of all, we have a lot of good data on this because the trend to passive investing began in the late 70s with John Bogle. I think 77, they create the first index fund, right, for the public. There was a private one run by Wells Fargo for some Illinois pension plan, if I remember right. By the late 90s, it had finally begun to pick up steam, but it was in single digits. But today, I've seen various estimates, let's say passive investing is 50%. So you heard these arguments early on that the market would become less efficient. And by that, I mean that it would be easier for active managers to win because you have so many people ignoring valuation fundamentals. They're just blindly following. Well, if that were true, then how do you explain the fact that over this last 26 years, we've seen the percentage of active managers outperforming collapsing? So here's another point. Jack, I'll just ask you, because you're a highly knowledgeable investor, how many mutual funds were there in the 1950s?
A lot less, but I don't even know the answer to that.
Pick a rough number. Today, let's say it's roughly 10,000, and maybe there's 10,000 hedge funds, just rounding big picture. So like 20,000 investment vehicles. There's probably more, but let's just use that. How many mutual funds were there in the 1950s?
Something in the hundreds, maybe?
About 100. There was almost no hedge funds, like maybe a couple were around. And even then, the markets were relatively efficient. Not more than, we would randomly expect outperforming persistently. Now you've got tens of thousands competing. And would you argue that today's investors are much smarter, have more knowledge of capital market theory, have faster or slower computers, more access to databases? Right? They have PhDs in finance or nuclear physics. They're rocket scientists. They have the best databases. And yet the markets were efficient with 100 investors, made it tough. We've got tens of thousands. The prices are today, I would argue, still the most rational, the best estimates of the right price now. So that means active management is even more of a loser game than it ever was. So that's one argument about efficiency. But the other argument is this. Clearly have less people who are actively trading, right? Okay. Oh, and by the way, 50 years ago, what percentage of stocks were held by individuals in their own accounts that they were managing? What was in the first
I'm probably like, individuals, a very small percentage.
No.
Maybe like
50 years ago, Justin, it was 90%.
90%. Okay.
Or maybe I need to go back a little further, make it so the 1950 or so. So coming out of World War II, only 10% of money held in stocks was held in investment vehicles. It was owned in individual brokerage.
Oh, interesting. Okay. Yeah.
Today, that number, of course, is probably flipped. And clearly, the institutional investors managing the money are more sophisticated than the individual investors, who we know dramatically underperform the market. So the market, clearly, it's harder to outperform because you're competing. The competition is much tougher. In 1950s, Buffett was competing against me and he'd kill me. Today, Buffett is competing against Renaissance Technology, JP Morgan. I mean, all these highly sophisticated investors were world-class mathematicians, all the best data and tools. It's much harder to outperform. Now, here's the problem. Markets have also gotten more efficient in trading costs if you're trading small amounts. Commissions are way down, bid-offer spreads are way down, especially when we went from trading in quarter or half points to deciles and pennies today. So the spreads are narrower. But because of the narrowing in spreads, and this is what I think the market hasn't focused on enough, because of those narrowing in spreads, there are no more market makers because they have no incentive to take positions where before they did because there was a good spread that they could take advantage of and be willing to take a big position. So if you're trading 100 shares, you're getting very cheap execution. You're an active manager, you got a 10 million share position in some company. Good luck trying to sell that stock. You can sell a few hundred shares or a few thousand at the bid price, and the price will start dropping very quickly as people figure out you're trying to dump. So market impact costs have gone way up. So here's my argument. While information may be less available because there aren't so many investigating these smaller companies, etc., right, the cost of implementing that and exploiting that information has gone way up, offsetting any benefit in informational efficiency. And I think the costs and risks of shorting have gone up. So you're going to see a lot less people betting on shorting. And those people who short are the most sophisticated investors who keep prices more rational. So I think you're going to see now more persistent overpricing, which to me is all the lottery stocks, the high growth stocks. There's more risk of bubbles because you can't correct those mispricings. Underpricings are easy to correct. You just buy, and all you can lose is 100% of your money. You go short, you can lose thousands of percent, and you can go bankrupt even if you're right in the long term, but you're dead because of the margin calls. So that's the problem here. I think in one sense, the markets are more efficient because it's harder to win, and therefore the right strategy is only to be a systematic investor. Don't try to pick stocks or time the market. Your odds of succeeding are minuscule. But at the same time, you're going to see more mispricing, particularly in the smaller stocks. You can easily go short Microsoft. You can't get squeezed there. Go short some stock with a few 100 million market cap, and it's easy for them to gang up. They discover they don't even have to buy the stock. They buy some out-of-the-money calls, and gamma traders who are writing that other side have to go in and start to hedge their position, and that pushes the stock up, and that more people jump in, and boom, and Melvin Capital loses $5 billion on a company that clearly was way overvalued, but they couldn't hold their position. It's a really interesting. So now what you would have is a paper by a University of Chicago professor. I forgot his name, escaping for the moment. Anyway, it's the inelastic markets hypothesis. So the markets are becoming more inelastic because of this, less liquidity all right, and the costs and risks of shorting, which allows more mispricing, particularly of these lottery-like stocks, the ones in bankruptcy, penny stocks, hyper-growth stocks without profitability that people are just betting on.
It seems like about a year ago, if I have my timing right, that more investors were talking about the risk of the concentration in the market. So a handful of companies making up, whatever it was, 30% of the overall market, something like the S&P. But I just did the math, and right now there's 7 basically tech companies that make up about 32% of the S&P as of today, even though your average stock has kind of caught up maybe a little bit here over the past month or so. But how do you think investors should think about this concept of concentration and market cap weighted indices?
Yeah, so I wrote about this in my book, Reducing the Risk of Black Swans, because concentration creates risk of big crashes. Every time in history, which doesn't mean it necessarily will happen now, or it might happen in 10 years, but every time we've had this concentration, it's been then succeeded by a long period of underperformance of those kinds of companies, 60s, 90s, and my guess is that's what we're likely, but not certain, to see now. The problem for investors, which I wrote about in my book, and I really urge your listeners to get a copy and read that, is this. If you ask Justin, the average, not only investor, but I've done this, the average investment advisor, and said you have a client with $1 million, say, in a portfolio that was 60-40 stocks and bonds, how much of your risk, what percentage of the risk in the portfolio is in stocks? The vast majority, say 60%, right? Because you got $600,000 in stocks, so your risk, that's clearly wrong. The actual number is much closer to 90%, because the stocks are so much more riskier than, say, bonds. If you own a typical midterm, say, 5-year treasury, the vol is about 4, right?
Mm-hmm.
And so 40% times 4 is 160 risk points, and volatility of a stock portfolio is roughly 20. So 60 times 20 is 1,200 risk points. So now add those two numbers up, and you can see almost 90% of the risk is there. And that's how you can get killed in years like 73-4, 2002, and especially in periods when it's inflation causing a bear market, because now your stocks and your bonds get destroyed. So I'm a big believer that you should own lots of other assets that have very different risk profiles. So adding things like value, momentum, other strategies like reinsurance, private credit, private real estate, where you're getting big illiquidity premiums even. Clearly, earthquakes and hurricanes don't cause bear markets, and bear markets don't cause earthquakes and hurricanes. So there's a logical reason to own it. It's a logical risk premium that's hundreds of years of data there. I would own long-short strategies like AQRs because they're uncorrelated to the market, and they're uncorrelated to bonds as well. And they have inflation hedges in them because as interest rates go up, they're sitting on that collateral. Same thing for reinsurance. Private credit is all floating rate debt. So you get rid of the duration risk. You're taking some credit risk, but you're getting a massive liquidity premium. And if you stick to the high credit quality, like in Cliffwater's fund, it's all senior secured and backed by private equity. Average LTV is about 40%. Historical defaults are less than 1%. Recoveries are like 70%. So you don't have significant risk there, but you're getting a massive premium that is unrelated to the economic cycle risk of either stocks or bonds. So my own portfolio looks much more like that of the Yales and Harvards of the world as I move from having very low allocations to alternatives like 10% 10 years ago to about 50% today. because I believe you should be a hyper-diversifier, and innovation has driven the costs way down. Let me just give one simple example. Say you're an investor in a BDC, a business development company doing private credit. And let's assume, for argument's sake, it's a well-run business with focus on high quality, like an Ares, something like that. Well, these funds were typically charging 2 and 20. Let's just say you could get 15%. Well, 20% of 15 is 3, 2% fees. You're at 5, now you're getting 10. You're giving up most of, if not all, of the premium to the sponsor. So I didn't invest. Today, the Cliffwater Fund effectively has an expense ratio of about 1.25 once you adjust for the leverage, which they don't charge on. They only charge on net assets, not gross. And there's no carry. Today, that fund is yielding 11.5%. So you're getting a massive risk premium. And a Vanguard high yield fund, which has worse credit risk, is yielding, last I looked, something like 7, maybe 7.5. So you got duration risk, you got more credit risk, and then you're giving up this premium just because you think you need liquidity. I've yet to meet a high net worth investors taking more than their RMD. They're in retirement, and you can get 20% a year at a minimum, right? Because you get 5% every quarter. Yeah, they don't own it because they need liquidity. The Yales and the Harvards long ago figured out that they could exploit illiquidity premiums because they only spend by their charters, say 5% a year. So you want to look for assets where you could take risks that aren't really risks to you, at least for some significant portion of the portfolio. So I think most investors should be owning, say, at least 30% of theirs, if they have access to the kind of vehicles that I invest.
Within the equity portion, how do you think about international diversification? I mean, it's been a long period of U.S. over international. We've had a lot of people on the podcast that just say, you know what, U.S. stocks, especially large caps, have a lot of their revenue coming from overseas. You're getting the international exposure through the profits. Or should, investors be more targeted or country specific with their international investing? What do you think on that?
Well, yeah. So the argument about U.S. multinationals own a lot of international assets, let's, for argument's sake, say Ford Motor has 50% of their sales overseas. Well, so does Daimler-Benz, and maybe more, right? And the evidence shows that U.S. stocks that are multinationals tend to trade more like U.S. stocks, and German and Japanese multinationals tend to trade like their stocks. So I don't buy that argument. The other argument is, again, this recency bias. International emerging markets far outperform U.S. in the 70s and 80s. 90s, it went the other way. The aughts went the other way. And now for the last 15 years, it's been reversed. There's no argument that anyone can make that says the U.S. can't be the next Japan. In 1990, everyone thought Japan was the only place you should invest. They had far outperformed. They were buying up Pebble Beach and Rockefeller Center. There was almost no semiconductor plants, even less left in the U.S. The head of Sony was on the cover, I think, of Fortune. They're going to take over the world. And the returns to Japanese stocks have been zero virtually for 34 years. And the same thing could happen to the U.S. It's possible. So the only right strategy, unless you have a clear crystal ball, is to diversify. Now, having said that, I believe that you should diversify because we don't have clear crystal balls. But you must recognize that the world is getting smaller or flatter, to use Thomas Friedman's words. So the correlations of U.S. and international emerging market have risen. So instead of, say, the correlation made between emerging U.S. might have been 0.6 40 years ago, now maybe it's 0.8. And the correlation of international might have been 0.7, and now it's 0.9 or something. So you still want to diversify because it's just logical, but you now need other sources of risk to add to the portfolio because international is not as effective a diversifier. It's still effective. It still adds value, just not as much as it used to.
What are your thoughts on artificial intelligence? Let me just ask you, have you used any of these like ChatGPT or Claude or any of these AI systems for anything that you're working on, like content or anything?
Yeah, I do use it. One, when I have a question, I want to summarize something like a key technical term, so I'll go in and I'll put a highlight in or a link, and to put a definition, say from Wikipedia. So that's what I used to do. Now I go ask Gemini and say, can you provide a short summary? And I'll take it and maybe write it myself. I'll also write up a paper. I always write them first, but then I'll ask Gemini to critique it. And I look at their critiques and they make some good suggestions and I incorporate it into what I write. But I never ask them to write a paper first. I think that's the wrong way to go about things. So I think it does provide value. I often find, some good small suggestions from their statements. So I use it regularly. And I use regularly to do research as well.
Yeah, and I think, and we'll see how these types of strategies pan out, but there are some firms now that are utilizing sort of a composite approach of these large language models to actually, they're kind of feeding it like the inputs of what they're looking for in terms of the stocks they're looking for, and then building portfolios that hold those types of securities. So it'll be interesting to see how that's
right. If you have your hypothesis first, then you could test the data and test it in infinite ways and do it fast that we couldn't have done. So that's why I think we're likely to see some minor improvements in implementation because of AI. But the big impacts have already been discovered because the factors that we have that in my book on factor investing, the 5 for equities and 2 for bonds, explain like 97, 98% of the variance. So how much more can you do? But you might be able to get better implementation. I know, for example, every good money manager today is using AI to do their trading. And to address my point, just to demonstrate this issue of liquidity, if you're a liquidity demander, you're going to get hurt. Dimensional, for example, told me recently, virtually all their trades today are 100 shares because they don't want anyone to see what they're doing and they want to keep their costs down. And so they just trade very patiently, being a provider of liquidity rather than a taker. And that's why, for example, AQR ran a test looking at trading costs versus what the literature said. And they found that their live trading costs, which is their sample, so they know what the costs are, were like 1/10 of what the trading costs that were estimated in the literature. So that might tell you that premiums are maybe bigger than some people think, as long as you could patiently trade.
So we have a new standard closing question. I'm going to throw it out here, see what you have to say to this. But what do you think is the one thing that you believe about investing that the majority of your peers would disagree with you about?
Yeah, this was a tough one for me to come up with one. But in my book on factor investing, we limited the equities to 5 factors that we thought people should consider. Beta, of course, value, size, investment, and profitability or quality. Profitability is just a subcategory. Now, actually, I put more money on the size and value and beta premiums because they are risk-based, at least to some degree. There is at least a risk. There is no logical risk-based story, I think, for quality and or momentum. Momentum, we know, is under or overreaction. Quality, to me, the argument is simple. If a company is lower volatility of earnings, lower debt ratios, is a safer company, how can you argue that you should get a risk premium for. But the data is so powerful that I don't ignore it. Okay. An investment is the same logic, right? So the ones I didn't really put in there, but came close to, was on low volatility. A lot of advisors emphasize this low volatility strategy, and it fails the test for me for one reason. First of all, it's purely has to be a behavioral story, right? Because if something is less volatile, that's certainly one measure, but not the only measure of risk. Okay, it's less volatile, it's less risky, and therefore should have a negative risk premium. So why do we have a premium? It's a behavioral story. Investors like to bet on these lottery stocks. They're higher beta stocks as well. High beta stocks have god-awful returns. Okay? So, but the data is strong. So why don't I recommend it? It's because volatility, as low vol, has only had a premium when it's been in the value regime. So I think you're better off owning value stocks that screen out the junk. Low profitability, focus on value that's more profitable, not high investment and stuff, so you don't get the other side of that behavioral trait. I think all you're doing is lowering your beta, and you shouldn't expect a premium. So low vol is good when it's cheap. Low vol is not good when it's expensive. This is a case, in my opinion, when I last looked at it, I haven't looked at it in quite a while, but when I last looked at it, all the money flowing into low vol had put it into the growth category. And guess what? Low vol has done poorly. That would be the one where maybe there's disagreement on.
Thank you very much, Larry. It's always a great conversation with you, and we really appreciate it. Thank you.
Well, thank you. My pleasure. Happy to come back anytime. These are important questions, and I wish I had all the answers. I'm only somewhat confident in them. Always have to be a little humble about what our beliefs are, which is why I hyper-diversify, by the way, because I know I don't have a clear crystal ball.
Thank you, Larry.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.